In April 2013, gold suffered one of its most sudden and severe price declines in years. It declined over 6% in the first half of April and reached a crescendo on Black Monday, April 15th, when gold declined almost 10% in a single day. The decline was dramatic, but not really surprising for long-standing gold investors. Gold is often volatile in the short run, regardless of long-term trends, and gold has seen such pullbacks before. Since April 15th, gold has rallied back strongly, and investors should bear in mind that gold is still up over 500% in the past 13 years, even after the recent setback. The April drawdown is not hard to explain. In early April, two prominent investment banks, Societe Generale and Goldman Sachs, issued negative research reports on gold. This was followed by reports that Cyprus would have to sell almost 14 tons of its official gold reserves in order to pay for its part of the EU-IMF bailout of the Cyprus economy. What happened on April 15th was outright panic selling. When a panic begins, it does not matter if the underlying commodity is gold or soybeans. A market will fall precipitously until the last leveraged player has been flushed out through margin calls, mark-to-market losses, or redemptions. What happened was a process of moving gold from the weak hands of the leveraged hedge funds and futures traders to the strong hands of real money players like China, Russia, and other central banks. The day after the April 15th crash, individuals lined up all over the world to buy physical gold, and spot shortages were reported in many locations. Volatility and price drops may be nerve-wracking, but the bull market in gold is far from over. In fact, it has barely begun. To understand why, it helps to look at two prior episodes in the relationship of gold and money that are most relevant to today. These episodes were a period of extreme deflation, the 1930s, a period of extreme inflation, the 1970s. History shows that gold does well in both conditions. Commentators frequently observe that we are experiencing price stability or low inflation based on the fact that the consumer price index has averaged 2% over the past 12 months. However, this average hides more than it reveals. The economy is experiencing strong deflationary forces as a result of weak employment and deleveraging associated with the depression that began in 2007. Simultaneously, the economy is experiencing strong inflationary forces as a result of Fed monetary printing. The deflationary and inflationary forces offset each other to produce a seemingly benign average. But below the surface, the forces struggle to prevail with some likelihood that one or the other will emerge victorious sooner than later. Let's start by going over some deflationary forces. Many economists believe that we will experience tremendous deflation when the bubble economy that we are currently living in bursts. The next major financial panic will cause a substantial deflationary wave first, and after that we could see unprecedented inflation as the central bankers and our politicians respond to the financial crisis. This will happen so quickly that many will get financial whiplash as they try to figure out what to do with their money. We are moving toward a time of extreme financial instability, and different strategies will be called for at different times. So why will we see deflation first? The following are some of the major deflationary forces that are affecting our economy right now. The velocity of money is at a 50-year low.